always the most helpful and the most interesting for both myself and Chris Martin is any questions that you guys have. Now, keep in mind, we have the co-CEO, Christopher Martin of Oaktree Funding. He's a wealth of information about, all of our non-QM, if you want to call them. I don't know if you like to call them Alt-A, the new subprime. I know some of these are dirty words.
Non-agency.
What's that?
Non-agency.
Non-agency. There you go. That's a good one. But we've got Christopher, who's got a wealth of information, who can answer all your questions for you. This truly is the time to do it. And just understand, if you have a question, other people have the same questions as well. So the more interaction we get from you guys is always great for us on this end, and it makes these interviews a heck of a lot more interesting. So with that said, we're going to get started here today. And as I said a moment ago, we have Christopher Martin, who's the co-CEO at Oaktree Funding. And he's a great partner of ours over here. We've seen his products, fight back from, a number of months ago when it seemed like, our industry was going certainly left, and now it's turned right again. A lot of new products are coming on board, coming online. And what this really means for real estate agents and lenders is it's just more opportunities to close more loans. Now, the second half of 2021, a lot of folks right now are talking about the winds of change could be on the horizon. We're seeing, economists, CEOs of major mortgage companies. I just saw that Genworth Financial today, an MI company, decided that they were going to postpone their IPO because it wasn't going to meet Wall Street's expectations, because they're concerned about how MI is going to perform. So we don't know what's going to happen with the winds of change, but they certainly are on the horizon right now. And having as many products available to you, more arrows in your quiver, is just going to help loan officers and real estate agents alike. I can't understand how any mortgage company at this point in time would deny their loan officers responsible products that could put more folks into homes. So with that said, Chris, how's it going, man? How's everything out there?
It's great. Busy. We've probably had one of our best months last month, and we're about to have another one. We're growing. Certainly the non-QM, non-agency market has come back quite a bit. We're getting a lot more attention, thanks obviously to you guys putting the word out there with us, and our efforts of our team contacting their client base and letting them know about our products and services. We're just busy. We're growing and we're excited. So we just bought Oaktree. We just closed on the deal in January. So my business partner Steve and I are running around like chickens with our heads cut off. But we stay. My job is to stay more product focused, and that's what I've really been trying to do. And this new product we're about to talk about, well, new additions to our product that we're about to discuss here shortly, certainly I think are going to help keep us even busier, but help a lot of people. Like we talked about when we advertised it, help them really shore up their 2021. So.
Yeah, and I want to jump right into the product here, because as we had a conversation yesterday, just full disclosure here, and as we were going through the details on this product, I just kept cycling in my head that a loan officer, even a real estate agent, you could build a business around this one product alone. I always kind of look at how do you stand out? How do you become the red hat to see a blue hats in this industry, which is a huge part of marketing. So our efforts don't get diluted by all the other loan officers and real estate agents. This is one of those products that allows you to don the red hat amongst a sea of blue hats. Because frankly, I don't know of anybody who's doing it right now. But let's just jump right into some of the details of the product, and then some actionable items for our realtors and lenders out there.
Right. Should I share my screen for the rate sheet, or?
Yeah, in fact, I think that would be a good idea. Let me hold on a second. I'm giving my screen.
Hey, that's your screen.
Yeah. Oh, hold on. Thank God we didn't have anything bad up there. Let me. You should be able to jump on right now. Can you check to see if you can screen share?
Host disabled participant screen sharing.
All right, hang tight, guys. This is a. Let me go over here.
I could send it to you, but.
No. I got. Here we go. Okay, we're doing this as a webinar, not as a meeting. So there we go. You should be able to grab the screen now.
There we go. All right. You guys see my screen?
Mm-hmm.
All right. So Those of you that are familiar with our products, we have our Investor Advantage program, which has traditionally been, you guys see the rate sheet, right? It doesn't actually show. Okay. Making sure you're not looking at my at my desktop. You can see our Investor Advantage product. If you're familiar with the way this used to look before, we had a rate grid on the left side and a rate grid on the right-hand side. The rate grid on the left-hand side was our DSCR program, and the rate grid on our right-hand side was our full doc / bank statement documentation program. What we've done is we've essentially taken, I'd say 95.5% of the full doc / bank statement pricing, and then turn that into what is now our DSCR pricing, and laid that out as the rate sheet that you see in front of you. In this instance, our base pricing is our DSCR pricing. In fact, when we scroll down and look at the adjustments here, if you're going to do an alt doc loan or you're going to do a full doc loan, those are actually going to be add-ons to interest rate. And before you guys say I'm crazy, listen, these loans are easy to do. All we're looking at qualifying the borrower is anywhere from 0.75 on up of the mortgage payment has got to be covered by the rent. So as long as at least 75% of their mortgage payment is covered by the rent, they qualify for a loan under this product. We don't have a reserve requirement for our DSCR program, and we do our expanding LTVs up to 85% loan to value.
Okay, so I want to go through this in a little bit more detail here for some folks who aren't understanding.
Absolutely.
This. Can you explain what DSCR means?
DSCR stands for debt service coverage ratio. Essentially, what that means is that your mortgage payment, it's the ratio in which your mortgage payment is covered by the rental income, or on a purchase, if you are using just the appraisal, the 1007, what the appraiser estimates the rental payment will be versus what the mortgage payment is on the subject property.
Okay, so to understand this, guys, for some of you folks out there who maybe haven't looked at a rate sheet before, and realtors, I want you to perk your ears up on this one, because this is big. You need to take this back to your loan officers and have a conversation with them and say, you need this product because this is going to help you and this is going to help your loan officer. And Oaktree, as far as I know, is the only one offering this. So what Christopher Martin said here is, if we are verifying any type of income, either through, it was a stated income, or what was the other one?
No, that's stated through bank statements or full doc.
Okay, so if we have bank statements or full doc as a means of verifying the income on the debt service coverage ratio, this DSCR program, if we're actually going to provide that to the underwriter, they're going to charge more money on the interest rate. What that translates to is they don't even want to see it, okay? So this isn't a stated income loan. This isn't a full doc loan with paycheck stubs and W-2s. This isn't an alt doc loan necessarily. It could be, but you don't want it to be, with bank statements. This is what we would call a no income doc loan, because there are no add-ons if you don't verify any of the income. That's huge, guys. It's huge. Think about the ability to repay, the ATR component of our qualified mortgages, and how it saturates every loan program out there. We are outside of that entirely with this product because we aren't even dealing with the income of our borrower here.
Number one, yeah, these are business purpose loans. So these are for investment properties only. They can't occupy this as their subject property. And they actually sign an agreement that says that they won't ever occupy it. This is only for investment purposes. We like people that are buying multiple units, 2, 4-unit properties that they're going to use for investment purposes. We want to see things that cash flow. If you do a full doc loan for somebody and the property doesn't cash flow, in our opinion, it's actually a higher risk loan than this type of loan, because if we know that the property cash flows, why would you get rid of an asset that's bringing you an income every month? So from our purposes, our perspective, we're looking at it is not higher risk with income doc or without income docs. We're looking at the income of the subject property as being the ultimate decision maker on whether or not this is a good investment to get, right?
That's a really interesting point. It's a good point too, because especially right now with people being underemployed, especially, and this is going to certainly target self-employed people. This is going to be big for self-employed people, everybody, but certainly self-employed as well, where, you know, the future of their business is kind of up in arms. There's a lot of people who are unemployed. There's a lot of people who are underemployed. But if you have a property that cash flows right off the bat, you would never get rid of that. It's like, even if your income from your primary source of income, if that goes down, the thought processing is, thank God I still have this investment property.
That's right.
But that's kind of a cattywampus backwards way of looking at this stuff, though, as far as the industry goes. Don't you think so? Most of the industry would disagree with that.
Well, I think that there are some in the industry that would disagree with it. I mean, I think that a lot of folks that have ever read Rich Dad, Poor Dad, or any of those types of books that talk about investing and real estate investing would certainly understand the thought process that we share behind this. Because it's, you know, when you're looking at a single family residence, you're gonna bring in money, you're gonna bring in income. You know, you might have even departed that residence. If the property is cash flowing positive, if you're making $500 a month extra, well, that's your car payment, right?
Yep.
That could be, or that could be your a tuition payment. That could be savings for a vacation. I mean, over the course of the year, it's $6,000 in income. I mean, and that's if you're doing a single unit. I mean, there are some people who are doing Airbnbs and things like that, and they're bringing in lots more money than that. But if you have a property that is able to generate assets and generate income, I think it's a great deal. It's a great opportunity for a borrower. There's a lot of realtors out there that I know that specifically work with investors, and they bring in investors all the time. And I was talking to an account executive yesterday they have an investment group in California, and they're like, wait, tell me about this product again. You know, we say, okay, hey, this is the product. This is the question and answer screen popped up. It keeps popping in my head. So we have lots of people that, you know, they don't know about it. There's an opportunity to use what's called leverage. It's what the big boys use in Wall Street. You know, it's a fancy way of saying using debt to further your income. It's like almost like buying on margin without a margin call potential.
Right.
So,
and I want to drive this point home right here. We have Jim Haley. I think this is a great question, because I still think there might be some ambiguity in terms of the whole point on the no doc. What documentation is used, according to Jim Haley? What documentation is used to determine your ratios?
So we'll use one of two different things. If the 1007 operating income and rent schedule, and Christopher Edwards has the same question here also, is what are future rents based on? If we use the operating income and rent schedule, the 1007 off the appraisal, there's always a rent schedule addendum on there where they estimate what the property should be renting for the market area. We'll use that. If that does not qualify and you want to use more, and you say, I've got a lease that shows that this guy's been paying for, you know, however amount of time, then we can provide that as well. So we can use that lease as well, as long as they've been paying on it. So, yeah.
Okay. We're starting to get a lot of questions here, which is great, and keep them coming, guys, because whatever you're thinking, other people are as well. So Michael Velez says, if it is a refi, do you use the lease agreement or do you use the appraisal?
We want to use just the appraisal if it qualifies. If we need to use the lease agreement, again, we'll use the lease agreement. There's some finite terms in the guidelines. I'll admit I am not an underwriter. I don't know it off the top of my head.
Sure.
But who is that? If you send me an email, K Martin, MARTIN at oaktreefunding.com, I will answer that question or have one of my guys answer it for you.
And by the way, everybody write that down right now. K Martin, MARTIN at oaktreefunding.com. Write that down. K Martin.
Yep. K Martin.
And everybody, let's blow him up. Let's blow his email up today. I think that'd be a great idea, because for real estate agents, you need to be talking to your lenders, your preferred lenders that you work with, to ensure that they have this product. Because I want to get into some more detail what makes it unique. This is a product unlike anything else in the industry right now. And like I said, you could build a business around this. Eamon McGloin says, can this product be used on commercial buildings?
No.
Okay.
No, we are residential only. We're working on a product to get past 4 units, but right now it's 1 to 4 families.
I think this kind of falls in the commercial, but I'll ask it anyways. Donna says, if I wanted to purchase a residential property to use as a senior living home, would they loan money for this? Probably not.
Not if we knew about it. So Donna, I'm writing your name down. Hold on. No. I mean, no, honestly, Donna, we if we're doing a refinance, and we've talked about this, we're in the process of looking at defining some guidelines that if it's a senior living property, but it doesn't have commercial signage and a commercial parking lot and has not been completely modified on the inside to look like a hospital or a hospice center, we're going to consider that. We're actually in the process of writing our guidelines to look at that, but we're not quite there yet. There is a competitor of ours that allows for a similar type of a product on those. They just add like 100 basis points to rate, but their guidelines are very ambiguous also as to what they will allow. So we're trying to get it very clear, and if it's under these particular circumstances, this is what this is going to be. You know, border rents, stuff like that. We're not really doing that right now, but we're looking to expand it. We understand that there's different types of properties that are residential in nature, and we want to be able to help those borrowers as well.
I want to get into, I believe it's pronounced Bazaret in a couple of moments, talking about rates and LTV on this, but let's jump over just real quickly to Christopher Edwards. He had a couple of questions. What's the future rents based on? But then he says, what is the debt service based on? What is included in the debt service? Any strange add-ons?
Property or pity or interest only. We don't qualify off the full AM payment if you're doing interest only. So pity, your homeowner's insurance, and that's it.
Okay.
Or homeowners association, any expenses with the property. So mortgage payment, the insurance, the taxes, there's a homeowners association.
Okay.
Anything that's tied to the house. If we find that there's some crazy, lien in Florida and, some county that we've only lent in once that has this monthly fee assessment, then we would obviously include that. But anything that would be associated with the property, we don't have any like, oh, hey, like this phantom like add-on to debt ratio or whatever. We don't do that.
What's interesting? I'm completely throwing this out of left field, but there looks to be counties in California that are going to start to dry up. Their wells are drying up. But I wonder what's going to happen with a qualifying and how when you have to start trucking water into houses and what's the cost associated with that. Side note. Anyways, okay, we have Jake over here. He says, this is a great question too. Jake says, what's a realistic time frame from app to settlement?
Well, we follow TRID by and large for all of our programs. So I know that some people say, well, it is commercial property. You don't have to follow TRID. Why do you guys follow TRID? We follow TRID because we feel like it's the right thing to do. It keeps our guys consistent. With the exception of the 3-day waiting period after the CD is issued, we do not follow TRID for that. So, we can close a loan, I would say realistically within 14 to 21 days.
Is that with the complete submission we're talking about?
Yeah, with a complete submission.
Okay, let's jump over here into Bazaret. He says, what is the loan to value for foreign borrowers? And, one of the things, I don't know if we really touched on this yet, but this goes up to 85% loan to value.
Yeah.
85%. That's a crazy, crazy number. But let's jump into some of the rates here. And
I'm gonna answer two questions at once because you brought up a good point at 85. And some people might think that's a crazy number. Some folks think it's better to do a 10% gift. I don't like gifts because those aren't really gifts. Those, especially to buy an investment property, that's probably a loan. So we're talking about an unrecorded second. We don't want to be in that market. We don't allow gifts on this property or on this program. But we did think that there was some room to expand the loan to value ratio. So that's why we did go up to 85. So as little as 15% down, you can have up to 2% seller concessions. But if you're putting 15% down, look, if you're an investor, you want to take your own cash and you want to put it to work. So most investors are going to be looking to put in the leverage ratio, the returns that you can get at 85% loan to value. Listen, I'm a property investor myself. I look at these deals all the time. In fact, when you asked about is there any strange add-ons, including the debt to income ratio, I actually just got for property because somebody tried to add a leasehold to it that wasn't there before. But they have this is a great product. They put in, if they're buying a decent property, put in a couple $100,000, they're going to get a good return on their value, even using this high of a leverage ratio. As far as the foreign borrowers, that's one thing we have yet to bring back since post-COVID is foreign nationals on our DSCR program. And the real answer is that a lot of our servicing partners, that when we pool and sell these loans into the secondary market, they had a very difficult time boarding those borrowers because they don't have a lot of times a social security number. They don't have a lot of the US residential address. So we ran into a bunch of servicing issues. We have actually set up our own servicing company, and we're going to start looking at doing some things, retaining the servicing of our loans. And as we do that, we'll be able to look to bring those types of products back. We just want to make sure that there's a very even flow from origination, funding, servicing for all of our borrowers, not just their foreign nationals, but everyone. And it was a very big challenge for us on the foreign end. We had a lot of collection problems, and not that those people weren't making their payments at any higher rate than anybody else. It was just that they were a difficult time knowing where to send their payments. So.
Gotcha. By the way, yes, Afi, this is being recorded, and we will get it out to you. And Robin, yes, we did say 15% down. Yeah, that's a pretty number on a program like this, isn't it? Let's talk about rates on this. Where are we at in terms of rates? And then let's talk about the 40-year term and the interest only option on it as well.
No, that's your favorite. I'm waiting for you to start sending in your own deals. And I'm licensed in California, by the way, if you really needed to do a loan, but I'm sure we have 55 other guys in this call that'd be happy to take your loan too. Let them have you. You'd probably be a jerk borrower. You want to know all about everything.
Oh, I would. But here's the thing that's so cool about this is we have what would be deemed I guess a relatively risky loan. I by today's standards, I think this is a completely safe and responsible loan. But by some standards, we're getting out there on the fringe of what you can do right now. And with that said, the loan to value on this is incredible. But the rates on this are remarkably competitive. I mean, I would have thought that they would have been 2-3 points higher than what they are. Can you speak about the 40-year option, the interest only, and where we are on rates on this?
You guys can see the rates. I mean, that's the rate sheet, so there's nothing really to hide there. But obviously, we do have adjustments. These are prepayment penalty adjustments. So depending upon, now I know that there's some people that aren't in Arizona or California that are on this call. There's lots of folks across the country. If you probably know New Jersey, and I'm going to miss all of them, but it has an issue with prepayment penalties. So we don't charge prepayment penalties specifically in New Jersey. So you'd have to buy out the prepayment penalty in that state. But if you have a customer that's okay with a longer term prepayment penalty, they can even get a lower rate if they expand it to 4 or 5 years. Our standard prepayment penalty on the program is a 3-year prepayment. That's 80% of 6 months interest if they pay off more than 20% of their principal balance at any given year. The credit grading goes as follows, like we talked about before. The interest rate add-ons, if it's a full doc or an alt doc type property, obviously the different types of deals that we'll do. Before we move to interest only, I'll just get there in just 1 second.
Sure.
The 2 to 4 unit property, we like 2 to 4 unit properties. And if you see on here, 2 to 4 unit properties below 75% loan to value, you actually get a quarter off your rate. The reason for that is that the debt service coverage ratio is usually very high, especially at a lower loan to value. So it's a very good risk loan for us. A lot of people hit all 2 to 4 unit properties the quarter, which we do above 75, but below 75, it's a great loan because you got 2 to 4 people, right, making your payment. If one person leaves, you have 1 to 3 people still left making your mortgage payment for you. Again, think about risk. That's how we think about it. And so that's why we want lots of below 75, 2 to 4 units. We love that product. So above, we do hit it a quarter because we do feel like it's a little bit of a higher risk type of property. Sometimes there's issues with the property. That type of thing needs to be remarketed if there's an issue, and that's all priced into the deal. Our interest only is merely an 1/8 of a point add to interest rate. We will go, as Brian mentioned, we will allow up to a 40-year term on all of our product types. So 5/1, 7/1, or fixed rate we do allow a fixed rate. So if you do the 40-year term, it's interest only for 10 years, and then it's 30 years fully amortized, whether you do an ARM or a fixed, same deal. So they can make their 30-year payment, or they can make their interest only payment. If they want to pay a big chunk down, They can, and then their loan, every time they pay any money towards principal in that 10-year period, their loan automatically recasts and the monthly interest is due on the loan is lowered, so their payment gets lowered. So if they get a tax return or whatever they want to do to pay some down on that, just don't exceed 20%. They can lower their payment. Investors love it. Listen, if you're a property investor and you're not doing a fix and flip, you're in it for the longer term, you're in it for cash flow. If you can cash flow your property on interest only, why not? Some guys want to pay it down and pay it off. They're welcome to do that as well. But and you can do fully amortized, or you can do interest only. So that if, let's say that you're fully rented, you got a 4-unit apartment complex, you're fully rented, you want to pay down principal, you're paying down principal, and all of a sudden you have 2 people up and leave. Well, now you still have the minimum interest only payment, and then maybe that's covered by the other 2 folks, and you can still make that payment while you get it re-rented out. You get the other 2 rented out, then you can go back to making principal payments. So it's just it depends on how you want to run your business. This is a business purpose loan. This is a loan that we put together for business owners that want to be investors in real estate.
How many of those are there out there? Again, this is just such an untapped market. I would put together a marketing plan on this thing tomorrow as a mortgage loan officer, and I would go talk with all my real estate agent partners, and I would get them on board with this thing and say, hey, anybody who invests, have thought about investing, aspires to be an investor, let's go run this whole thing down. It's a great program. We have Paul Alexander says, what rate spread between you and agency taking in consideration the new 7% purchase loan from agency?
Let's talk about that in a second, because we have another program
Okay.
that I think we want to cover with that on the more agency side. The guys that are more like agency borrowers that really want to document full doc and those types of things. The rate spread, it's not much. You figure you're 3 3/8, probably at par. We're at 3.625. The only difference is that our loan has a prepayment penalty, the agency loan doesn't.
Right.
So there's not much difference, in my opinion, on listen, you might have super duper rate out there that's lower, but if every time I talk to a broker, everyone has their go-to agency investor, and they've got this great super low interest rate. But I don't think the spreads are that wide. You guys would have to tell me that these are the rates. They're right there on the screen.
I think they're fantastic too, especially when you look at the interest only option on a 40-year term. That's pretty good. 85% on refis, and is there a cash out on refis?
We do allow cash out.
Okay.
I'm switching over to the matrix here so you can see it.
All right.
This is the income documentation, so full doc or alt doc. The DSCR program, and then DSCR, it's based on the debt service coverage ratio leverage, and then obviously by FICO score. So for a cash out, we allow, this is purchase money and rate and term. I'll have to make sure that gets updated, but cash out up to 80%, up to 1.5 million. To get up to that, obviously our FICOs tighten up a little bit, and then we're up to 80 and 70%. So these are all on our website at oaktreewholesale.com/products.
Jim Haley says, is Oaktree funding wholesale part of your company? If you're talking about me, no, but right now me and Chris are in a negotiation to have him adopt me. So then I would be part of wholesale funding if that's me. How many states?
Oaktree funding, the website is oaktreewholesale.com. It's Oaktree Funding's wholesale division. Yes.
Right.
That's the question. I don't know if there's another Oaktree Funding wholesale company out there. If not, this does.
Right. How many states does your company lend? Is that on your page, rather than going through it state by state?
You can go to if you just go to nmls.consumeraccess.com or .gov, you can see. I believe it's 30 states, 29 or 30 states, and that includes DC. Christopher Edwards asked if we're licensed in Massachusetts or New Hampshire. Yes to Massachusetts, and in the process in New Hampshire.
Yeah, and as we're going forward, guys, if you're participating with a National Real Estate Post, as they're bringing more states on, we'll make sure that we announce those on the show, and we'll make sure that we get that information out to you. Are we aggressively looking at expanding into more states right now?
We have some great states right now. I mean, we have some great states for lending in. I am certain that we're missing some other great states for lending in. We're looking at New Hampshire. But we're going to talk about this more next week. We've hired a gentleman to focus specifically on the East Coast of the United States. So we're going to have some multiple account executives and back east in some regions that we haven't seen a whole lot of penetration in yet. And so we'll talk to him next week. But we are going to continue to add states as it makes sense and is reasonably prudent to add those states. I mean, there's certain states we probably won't get into right off the bat. I'm sorry, I know New York's one of them. There's a lot of folks that ask, "Hey, are you in New York yet?" And we'd love to be in New York, but it's a 2-year process, and it's very tedious and very time consuming to get into New York. But we'll get there. We have some other things that we're trying to work out. We might be able to kind of jumpstart that. So, but most of the other states, I mean, if you guys are ask, "Hey, I've got loans. I want to send you loans. I've got 5 loans in your state," then we'll look to add those additional states. Which is a long way of answering your question.
It looks like, by the way, it looks like Jeremy's down there in the chat answering a lot of these questions. And I noticed that Jerry Jones just asked if you're in Illinois. Jeremy, if you could kind of keep answering those questions down there in the chat, I think that's really helpful. Let's see, we got a couple over here. Is the minimum credit score is the minimum credit score on the DSCR 620? What is? Yeah, we have that on the matrix up there, didn't we?
Yep.
Okay, and Roxanne, the link to the sheets, and I believe that's something Jeremy Ray.
Yeah. Okay. If you go to oaktreewholesale.com/products, you can get access to the guidelines and to the matrix. If you want to have a copy of our rate sheet, you can simply email me. We already put my email out there. kmartin@oaktreewholesale or oaktreefunding.com. And you're able to, I'll make sure you get added to our daily rate sheet distribution email. Obviously, you have to be a mortgage professional. We don't send rate sheets to borrowers. But
it's also worth pointing out that one of the many things that Oaktree does really, really well. If you're a loan officer or a mortgage company, you want to sit down and get more detail on a one-on-one basis with these guys, they'll have their account rep sit down with you and go through these products and answer a lot of the questions that might be getting overlooked here today. So make it a point to reach out to these guys. They're remarkably helpful, and they'll go through all their products with you. Because I'm telling you, there's as I've said before, there's a complete full spectrum business for a loan officer in the products that we have offered here. I think we kind of glossed over it. And again, I know we have a lot of realtors on here, so I want to make sure that we're speaking to them as well. But there is a benefit to doing a 40-year loan with a 10-year interest-only option on it. And it's very thoughtful. A lot of these products are very intuitive and pragmatic in nature. Do you want to talk about the 40-year term and when it casts and it turns over to its 30-year fixed? Yeah. What the rationale behind that is?
So it's interest only for 10 years. If you're going to do a 40, we don't have an option to do a 40-year fixed. We only allow for 40 years. And the first 10 years of those are front loaded as interest only. So as soon as the loan is, your interest only period is up, the loan then recasts to a 30-year loan. Well, the reason why that's beneficial is, look, during the crash in 2008, right? Everybody had these interest only loans that were in there for like 5 years. They did 5-year interest only loans on a lot of these subprime programs.
Yep.
So 5 years happened very rapidly. So 2008, 2012, sorry, my math is great. 2013, all of a sudden, boom, now your loan payment is based on a 25-year loan, not a 30-year loan. So your loan payment went from being low to being high. And a lot of them were 10-year loans. So 2018, if you didn't refinance out of it because you're a self-employed borrower and you weren't aware of being able to qualify with bank statements, all of a sudden you went from a nice, easy interest-only loan payment to a 20-year loan payment. So, did we get off the screen? Mine kick off or did yours?
No. Oh, no. It stopped screen sharing.
Okay.
For a second. You can pop it back on over there.
That's all right. Unless anybody needs to see it again. So.
So that's a really, this is, if you weren't around writing loans back in 2007, 8, 9, and 10, I mean, this is a big issue, because what would happen is when your loan would recast and you would go from that interest only period, to where it was fully amortized, your payment would go through the roof. It became something of a mess. So if you think about it, the thought processing behind this loan is, and mortgage companies don't want to hold loans for 30, 40 years. They don't want to.
No.
But what's so great about this is they're extremely thoughtful in terms of from the investor's perspective. They're giving them a reasonable option to hold on to this loan longer than any mortgage-backed securities provider would want that loan to exist for. So it's remarkably thoughtful.
Those get refied every 3 years, so no, they don't want to hold on to them very long.
Right. Hey, do you want to switch gears and jump into our other products?
Yeah, I'm going to do that real quick.
And then you're going to want to jump back on that screen sharing too.
Yeah, I will. Just 1 second. Let me.
Ken.
Super prepared. All right, there we go.
I love all the questions. This has been killer. The interaction's great, guys. Thank you so much for all this.
And yeah, if we missed anything, you get a copy of all the questions, right?
Correct.
So I can get to those. So you kind of asked about the spread between.
And by the way, just real quick, can you full screen that? Is there a way to make that any bigger? Okay.
It is full screen.
Okay.
I don't know. Is it? Oh, you mean like, I don't know how to do that. I have to get somebody in here to figure that out.
I think that's as big as it goes. I just was kind of curious on it. Hey, listen, guys, if you want these matrices, we're going to get these over to you. So if you're having a hard time seeing, if you've got like 48-year-old guy eyes like I do, we'll get these matrices over to you so you can check them out a little bit as well.
So this program we work to develop with one of our investors is we call it our prime investor non-agency. It is a Fannie Mae, Freddie Mac lookalike to their investment property program. They have a couple of LLPAs that we just brought over. We could have included the investment property add-on in the pricing, but it always changes based on loan to value. So we left it off. But I mean, realistically, if you're doing an investment property, it's, the starting hits 2 1/8. If you look at, and I don't know every single of our competitors, loan level price adjustments, but our investment property add on our standard conforming program is rather large. It ranges from 5 to 7.625%, depending upon the loan to value that you're at. So obviously the price difference, and I don't know if you can see my screen, I'm trying to show that's our add for traditional investment property to our base pricing.
Okay.
When you go back to our PINA program, Prime Investor Non-Agency, the add-on is really only the 2 1/8, and then it goes to 3.375 at the higher loan to value. We do max it out at 80% loan to value. Now, there's a couple of really nice features about this program. If you're talking about a standard, this is for a standard traditional DU underwritten full doc investor. So, this is the guy that, may have been an investor for a long time, is trying to refinance. If they want to put more of a substantial down payment, they maybe want to try to get an appraisal waiver. That's probably not going to happen, but it might. You're going to start, and the rates are going to be lower, around 3.375 to 3.5% for a well-qualified borrower. The nice part about this one is that if you do a high cost loan or a high balance area, you don't have to live in a high balance area to get a high balance loan. It's just a different pricing structure for us. There's no additional credit guidelines or overlays. And if your DU comes back approved ineligible, provided the only reason that the loan's ineligible is because of it not being an accounting area that exceeds the high loan limit, we're going to accept those DU findings.
Okay.
Same goes for exceeds high balance. So up to $1.5 million. We even price jumbo investor loans on the same type of price grid and credit methodologies, using the DU as our only approval source. We don't really have much in the way of overlays on top of the DU findings for this program. This is just a way for people to still be able to add and be able to continue to provide investment property loans at a decent price, not the crazy pricing that a lot of the other guys have gone out to market with. Obviously we have this on here because it's adverse refinance fee is zero, just to show that we're that's not something that we're selling to the agencies, right? So this is a different product altogether. But obviously our loan level adjustments we feel like are very, very competitive.
So just real quickly, again, why would somebody use this product over like a Fannie or Freddie product?
It should be better priced.
Okay, does everyone understand that? It really is better priced when you're looking at what the add-ons are.
I'm not going to sit here and get on ceremony and tell everybody that I'm an expert at agency pricing across the board. This is better than our agency pricing, which, if you're familiar with the broker secondary guide, has been near the top in the past couple of weeks as far as competitiveness and agency pricing goes. And this prices out better than our agency pricing, just based on those loan level price adjustments. You can see the difference. So,
well, and here's the thing, guys, is I mean, if you have this tool in your toolbox, you can always compare and contrast it against your agency stuff as well. But I mean, kind of just, with one arm tied behind my back and one eye closed, it looks to me as it would be better pricing. You guys would be more qualified to figure that stuff out than I would.
That's another option. It's in our system. It's priced. If you're pricing the loan out, it is priced with our conforming product suite. Don't price it as a non-QM loan. It's priced as a prime loan.
Okay.
We do even allow property inspection waivers if DU provides it. So it's not a traditional non-QM loan. It is definitely priced, underwritten, proved just as we would any other conforming loan. So,
man, these products are great. They're absolutely fantastic. Are you guys looking to bring on more products right now? What does the future hold for Oaktree right now in terms of product offerings?
We feel like we're fairly pragmatic as far as it comes to developing and working with our investors to bring on new products. We just released our titanium program last month. We did a big webinar about that. It's an agency, especially a prime agency fallout. We talked about the interest only advantages to that program. We've gone, it links on our DSCR program and our investment property programs. We're always looking to get feedback. We keep our ear to the ground as far as as what our competitors are doing. And if there's a program that we can offer that we feel is a reasonable product, and it's one that we can listen. We always talk about the triangle, right? And it's got to work for everyone. It's got to be a good product for the borrower. It's got to be a good product for Oaktree, and it's got to be a good product for the originator. Because if it's hard for the originator to underwrite or to originate, they're not going to do it. So why bother offering? If it's not going to be a product that's going to be a safe product for Oaktree to fund, then we're not going to do it. We're not going to take those types of risks. But if it's not a good product for the borrower, then in no way, shape, or form should we be offering it. So,
right. It's kind of funny. It's true though. If it's not good for Oaktree, it's not good for the borrower, which means it's not good for the lender. It's not good for the loan officer, the realtor, nobody. So that's, right. And I like that. I'll tell you this right now. This is the most exciting vertical that I'm seeing in the mortgage space right now. What's going on with non-QM, because the products that they are being brought on right now are really well thought out. What we were talking about earlier, what you said is, hey, if this thing pencils with the rent, well, that's a safer loan than on an income. I mean, that makes perfect sense. Then when you explain, well, we love the 2 to 4 units. Well, why is that? Well, because what you're doing is you're diluting you've got risk mitigation with multiple units. It's a very pragmatic way of looking at underwriting, and I think that's great. I just had a note put in front of me, which I think is funny and very, very appropriate. With all the great products you have and the growth that you guys have going on right now, surely you must be hiring. Are you guys hiring right now?
We are looking specifically for account executives, primarily in the East Coast and the central regions where we don't have a lot of coverage with our current staff. Certainly, if you're interested, if you're at a shop right now and you're thinking, man, I'd love to be able to offer these products and services, and I just can't. We'd love to talk to you and have a conversation with you. So if you're interested, man, I've given my email out enough, so I'm gonna have to change it. No, I'm just kidding.
Oh, just one more time. Just one more time.
KMARTIN @oaktreefunding.com.
Kmartin at oaktreefunding.com. Kmartin at oaktreefunding.com. Are you looking for experience?
We'd like to have experience. I mean, listen, if you're on this webinar right now, you're in the business. You understand mortgages. We're not, obviously, if you're looking for a transition, you're looking for a change, we'd love to have a conversation with you. We have a training program. A lot of those folks tend to be more in Arizona because that's where our office is, and we can kind of really help you. It does take some time. I know that some folks are like, oh man, being a wholesale AE is easy. If you ask my wholesale account executives that, they're going to tell you, no, it's a lot of work because you have to not only listen, to be a good account executive, the way I've always looked at it is that you almost have to be, at the very least, a junior underwriter, and at the very most, a senior underwriter. Our best account executives know the guidelines just as well and can go toe to toe quoting guidelines like verse, page, and scripture number with our underwriters, because they want to be able to make sure they understand and can make deals work for their clients. So it's important that they understand the guidelines. And there's a lot to understand. We have a lot of different programs. We try and consolidate, but then we're like, oh, we see a need that we need to grow here. So we do always expand our program. We have jumbo programs. We've got an ARM jumbo program, a fixed jumbo program. We have agency programs. We have this new PINA program we rolled out. We have the DSCR programs. We have the Advantage program. We have the Titanium program. And they all kind of roll into each other. They all very sequentially make sense. But you got to understand them. You got to know them. You got to know the nuances. You got to know how to work through them a little bit. So, so the short answer to your question is yes, we'd love you to have experience. If you don't have a lot of experience, we'd love to have a conversation with you and see where that goes.
Yeah, you can't teach hustle, man. You can't teach hustle.
Oh.
You know what's interesting about this, though? Another thing that I love about the non-QM space right now is this kind of harkens back to an old school day of writing loans where, for the past decade, we've had your meat and potatoes, your Fannie, Freddie, Jenny. I mean, that's all you pretty much had to consume. With all the non-QM stuff that's coming on board and all the products that you have, this truly is where you earn your keep as a loan officer, because when you're sitting down with a client and you're trying to determine whatever the best program is for them, for the past decade, it's been pretty much straightforward. It's Fannie, Freddie, Jenny, write that loan, put it into go get your approval on it, and you're done. But now, with the products that are available, this is going to really distinguish between the great loan officers, the good loan officers, and the ones who should be, possibly looking at other professions. I just love that about this space. It's so cool. Looking at all like this are great.
We tell people, it's the hardest sell for non-QM for the longest time was that nobody knew what it was. And they'd be like, what do you mean? It's subprime, blah, blah, blah. I mean, it's similar. We used to do bank statement loans back in the subprime days. Like the rate sheets look, rate-based pricing, all that kind of stuff. Like what do you mean? Everybody understands it. Really, no, because if you think about it, if you got in the business in 08 or 09 and you were in the business until, for 10 years.
Yep.
That's 2018, 2019. I mean, you could be in the business. That's a career.
Yep.
You could be a successful loan officer in the business for 10 years and knew nothing about that.
Yep.
And that's why we're here. We need to re-educate folks because it's a different program. It's a different process. It's a different way of looking at the underwrite. Can you make exceptions to DU? No.
Right.
It's either approved or it's not approved. The little magic guy behind the scenes tells you whether or not you can do your loan. I'm kidding. But here, I mean, listen, if you had a deal that was at, if you had a loan, let's just look at this matrix for a second. Let's say you're at, let's say, let's give it down here. Your cash out loan, you got a 680, you got a 672 FICO score, and you're at 75, and you want to get to 80% LTV, and you're doing cash out. Well, let's talk about why is that needed? Well, I'm doing a home improvement or I'm buying another property and I want to, whatever it is, let's talk about it. Then maybe we ask the question, this program doesn't require reserves. Do you have any reserves? What's their other contributing, what are the other factors that we can go into to see about making an exception on this type of loan? And then once we go through that and we explore those, we can make exceptions. We make exceptions all the time. So, a lot of guys will go to our pricing engine. Oh, they won't do it, and they'll go on. If you go to the pricing engine, won't do it. Call the AE. your AE has a form they can fill out, goes right to our secondary marketing department, and that can tell you within a couple of hours whether or not we can make an exception to that loan. Make sure you bring all the extra, extenuating circumstances or whatever the case might be. If they've got excess reserves, low debt to income ratio, if it's a full doc or a bank statement loan, they've owned the business for a long time. Great curb appeal doesn't work anymore. I know my business partner always likes to throw that in there, but a great curb appeal is not one that we make exceptions on anymore. But everything else, I mean, we're talking about the borrower's ability to repay. How do we build a case for them to make that exception? And if we can make the exception, we'll do it. We want to help borrowers deals that make sense. We do a lot of make sense lending. So
yeah, that's a great point, Chris, what you said a moment ago. If you had somebody who got into the business in 2008 and they wrote loans till 2018, that's a decade. It's a whole career. You could have somebody, to take that a step further, you could have somebody who's been in the business now 13 years, well past a decade, who's never once looked at a pricing matrix like this. How many people have been in the business longer than 13 years? I don't know what the numbers are, but here's the point. The vast majority of people writing loans right now have been in the business 13 years or less. So if you want to roll your sleeves up and learn all these products, it's going to open up an entirely new set of opportunities for you in the mortgage space. Because again, I keep going back to the point. There's so many people who don't, fit into your Fannie, Freddie, Ginnie loans. They just don't fit into them.
Nope.
And there's so many ready, willing, able-bodied folks who should, could, and want to buy homes. And it's the products that Oaktree has that are going to make that possible for them. Again, with the changes that we have coming for the second half of 2021 and 2022, we don't know what the future holds. I have a sneaking suspicion we're going to start to see a little bit more inventory come on board. I'd be willing to bet almost anything on that. Working with your realtors, the purchase market, and understanding these products are going to be the difference between having a good and a great year, guys. It's just that simple.
And if you guys have, real estate agents, if you have a broker that you're working with that doesn't offer this product or doesn't work with Oaktree, we'd love to talk to them. Send them our way. We'd love to have a conversation with them and train them on how to do these products and really help your borrowers maximize their investment property potential.
Well, that's what Chris would say. Here's what I would say. Go talk to your lender and tell them if they don't get all the products that Oaktree has available, to make them available to you, that you're going to find a loan officer that has Oaktree's products, and you're going to start working with them. Just kidding here a little bit, just a little bit. No, but seriously, reach out to your loan officers, realtors. This is going to have just as much of an impact on your business as it is loan officers' businesses. Let's get Oaktree approved with all the lenders out there right now. Go twist those arms of the loan officers that you're talking to. Let's get Oaktree approved. Anything on the way out the door, Chris?
Valerie just asked about, could a 2 to 4 units, could a person occupy one unit and then the other rented on a 2-unit purchase? No, not on their DSCR program. that is a business, not on any investment property program. That is a business purpose loan only. You have to sign, your borrower has to sign something that says they will never occupy the subject property nor any of their family. It's for business purpose only. We do not want to have people that, it's reverse occupancy fraud, to be honest with you, and we can't have that. So
Kat, let me tell you something funny here right now. I know a guy who owns a trailer park.
Like, we don't do those.
No, but I know a guy who owns a trailer park. He owns the whole damn thing. If you want to see UFC fights, all you have to do is take a 12-pack of Schlitz and drop it in the middle of the trailer park on a Friday night at about 7 o'clock, and trust me, you'll see fights. Anyways, here's the point. The point is that he lives in the trailer park. I mean, he makes over $1 million a year, but he stays there so he can stay on top of it, so it doesn't get too rowdy. But at the end of the day, his whole life is he's living in a trailer park. It's kind of nothing wrong with that if that's your thing, but I've never understood it. It's the same thing with being a prison guard. Out here in Vacaville, we've got a fairly famous prison, and I've done like 1 million loans for prison guards and love these guys, respect them for what they do. Thank God they're doing it. But at the end of the day, it always kind of struck me, you're in prison. You took a 30-year term in prison, on a 4-unit thing. Can you live there? My thing is, if you can afford a 4-unit, complex, would you really even want to live in it? That's always kind of been my thing.
Some people can, some people do it, and it's, listen, if you're single, or maybe you're retired and you want to downsize and you want to have that protection of the other, of other people making your mortgage payments, I could definitely see somebody wanting to live in that situation. You know, it just depends on your situation. And that's why, you know, we like to be as pragmatic as possible, because, you know, what's great for me, it might not be great for you. And what's great for somebody else might not be great for either one of us. So it's everyone, we're trying to just to get through this thing called life one day at a time, and the best way that we feel like we can do that. So, and we understand that. And that's the awesome part about this business. That's the great part about mortgages, because every mortgage requires a 1003. Every mortgage requires a title report. Every mortgage requires some type of income, you know, association, whether it's DSCR or otherwise. So they're all same in that, but every person's different. That's why that's what makes this business great, because if we can you know, help every person with their unique situations, we want to be able to do that as often as possible. So
absolutely. And I just want to Robin has a question. I just want to make sure everybody's clear on this, because sometimes people miss things. Who could I contact to get information and more details on these products?
K Martin at oaktreefunding.com. I should have given my marketing person's email in the first place, but because she does a great job, I'll be forwarding lots of emails to her today, I have a feeling.
And everybody, and by the way, just to let you know, everybody who's on this is going to get an email from us afterwards, and we'll make sure that we have all that contact information there for you. If for some reason, you know, we get scatterbrained the next day or two, you can always reach out to us over here at the National Real Estate Post.
Absolutely.
And
MortgageShots@gmail.com right now.
MortgageShots@gmail.com. No, hey, listen, MortgageShots@gmail.com. Listen, Chris, I look forward to really kind of growing this. I think we're going to have a great summer together.
Yeah, absolutely.
Look forward to doing more interviews like this. Right. I think this is all good stuff. And I want to watch this grow. And hey, listen, if you guys are working with Oaktree in the future and you get a couple of these deals closed, where you just simply, these are deals that wouldn't have closed a couple of months ago, do me a favor. Reach out to me and tell me about the experience, because these are cool things to share with other loan officers and realtors out there.
Yeah, absolutely.
We're gonna have an interesting second half of the year, and we're all in this thing together, man. So let's do it.
And we send out an email every time a loan closes. Every time a loan funds, there's an email that comes out for me that asks how your experience was, and if good, bad, or indifferent, I'd love to hear the experience. So.
All right, guys. With that said, thank you so much, and Chris, look forward to talking to you, seeing you guys soon. And
maybe you'll get out here one of these days. We don't have any mask ordinances here, so come on.
Hey, listen, say when, man. I'll jump a plane tomorrow. I'm dead serious. I'm ready to go. With all this COVID stuff, I haven't been doing much traveling. I'm getting antsy. I got to get the hell out of here.
Well, come on out and visit us.
All right, we'll do.
We got a new office to show you too. So
that's awesome. Thank you so much,
good
guys.
to see you. Thanks, everyone.
All right, bye.